I have some questions for you, then we'll go to the Senate colleagues. I guess just starting out with your mandate, does your mandate require you to consider the particular factors facing first home buyers or prospective first home buyers?
Thank you, Senator. Our mandate is about the overall system stability. It doesn't distinguish between any one category of borrower, but we are charged with ensuring that we understand what's happening within the credit, within the system. In our financial stability mandate, we balance that, of course, with competition and efficiency and contestability, amongst other.
Okay, so the answer to that is no. What about in relation to the government of the day? The government of the day often sends you a statement of expectation, does it not?
Yes.
Okay. And in this statement of expectations for the current government, when did you receive that?
I don't have the exact date, but it was early in the term. I would say we can take it on notice the exact date, but early 2023.
Yeah.
Actually, I've got the date. Apologies. June 2023.
It doesn't appear to look at ask you to look at first home ownership as a virtue either, does it?
We are not mandated to look at any one borrower class. There's often interest to understand various lending to different segments. First home buyers is obviously subject to today. We're often asked about lending to small businesses, lending for infrastructure. Importantly, what we do is we set a framework which enables a sort of neutral understanding of the risk in the system, and that's what, in particular, our credit rate system provides, the ability to understand the risk in the system. I would say one thing that's interesting about our statement of expectations, it talks about to facilitate the flow of finance to support strong, sustainable economic growth.
Yeah.
And that's something we do see, that a strong and stable financial system does, in fact, enable that strong, sustainable provision of finance. We see it in the data, which I've already talked about. It enables people to go about their lives, get access to finance where it's appropriate. So, and also for businesses to do their business.
Sure, but it doesn't, the point is it doesn't ask you to do anything on first home ownership, and nor does your mandate, which is not your problem. I'm just trying to get to the bottom of where exactly we start here. But then it does go, the statement of expectations does ask you to look at the expenditure matters of the superannuation industry and various other things to do with superannuation. So the government can be quite particular if it wants to be, can't it?
But what our statement of expectations is a matter for government. That's correct, Senator.
Yeah. Okay. How much capital are the banks currently holding against mortgages?
Well, they hold a capital on a proportionate basis. We've seen capital levels. Our requirement is that they would be unquestionably strong, and they hold capital across their whole book. And those levels are well above the minimums as we require them.
So you said that through your prudential standard?
Yes. So we set expectations for how banks would measure and calculate their risk, and then the capital that they would hold against that.
Which prudential standard? Is it capital adequacy or another one?
I might turn to our head of policy.
So the capital risk management, is it?
So the relevant standards for there's a range of different standards that specify the so-called risk weighting of different types of exposures, and the two relevant ones are known as APS 112 and APS 113 that specify for credit risk what the capital requirements are for all the different classes of lending.
So what are those two prudential standards called?
So the one is about the standardised approach to credit risk capital, and the other is about the internal ratings-based approach to capital. So
they're called?
I'll get the wording slightly wrong if I say it, so maybe we can give you the exact ones on those.
Well, I can just Google it if you don't know. I mean, it's not going to be that hard. What are they? So sorry, you don't know what the prudential standards are called?
There's APS 112 and APS 113, which is the ADI Prudential Standard 112 and 113.
Okay. But what are the name of the documents? Are they capital risk management or are they capital adequacy? What are they called?
I can Google it on the spot for you to get the exact name, but as I say, one of them is relating to what's called the standardised approach to credit capital, and the other is the internal ratings-based approach. So 112 is capital adequacy, standardised approach to credit risk.
Okay. So one's called capital adequacy. What's the second one?
And the other one would be the internal ratings-based approach. So essentially the same thing, but is the internal ratings-based rather than the standardised approach.
Okay. And in these standards, you set how much risk capital the bank should set aside for mortgages, don't you?
That's right. So essentially it comes up with what we refer to as risk weights, where for a given dollar of exposure, that'll be weighted by a risk weighting factor that is basically a measuring tool that looks at the relative risk of different risks. So, for example, mortgage lending, being a type of secured lending, is relatively low risk compared to credit cards, which attract higher risk weights, as an example.
Okay. And then do you apply different risk models to different types of mortgages?
There is, within the standardised approach, there was, I think you've heard in some of the previous hearings that there were revisions made to the capital frameworks a couple of years ago. That was with a view to making increasing the risk sensitivity of these things. So it does differentiate a bit more on different risk factors, and the two key drivers are in the risk weights for owner-occupied, sort of standard owner-occupied prime principal and interest mortgages have a lower set of risk weights than for interest-only and investor loans. And the other key dimension is there's bands by loan-to-value ratio. So low loan-to-value ratios have lower risk weights and high loan-to-value ratios have higher risk weights. And lastly, there's a differentiation for those higher loan-to-value ratios, those above 80%. They also are differentiated based on whether there's lender's mortgage insurance in place or not. So that's within the standardised framework. The internal ratings-based approach, which applies to a smaller number of the larger banks that have more modelling capability, those factors are supplemented by their own credit risk modelling, but they're subject to a floor that references the standardised approach. So they might have more granular differentiation of risk than those standardised approaches. So they're the key.
So there's a wide range of approaches, isn't there?
So, Senator, I might just before we get into more detail, just step back just a moment, which is just to talk about, well, what is the framework trying to do? And the key point that Sean was talking about there was the measure of risk. So if you think of a ruler,
I understand that.
This is about the measure of risk. It is not an incentive tool. And it does have gradations within it, which you're hearing about. And that's because the core aspect being considered has a different risk performance.
Yeah,
so that ability to understand the neutral setting and such that that we can ensure that the right amount of capital is held against that. And organisations can make their commercial decisions accordingly as to which sort of sector they will play.
I understand that. Sorry, I don't have a whole lot of time, so trying to keep answers as brief as we can so we can share the call. So basically, there are a range of different approaches which you have deployed. So you've taken the view that investment loans should carry a higher risk weighting than non-investment loans. Is that right?
That's correct. In the framework, that's one of the differentiating factors. Correct.
Okay. And so then what generally do banks do? Do banks then, if they hold a higher amount of capital against a mortgage, then what pricing impact does that have in the market?
Well, practices will vary across banks, of course, but obviously, ultimately, the amount of capital that they hold, given that they need to generate a target return of capital at some level of return on their capital for shareholders, will be one of a number of factors that go into the pricing of their products. There'll be operational costs, a whole range of other things, but absolutely, in all else being equal, you'd expect that loans subject to higher risk weights, given that they're more risky, will also, on average, attract higher margins, which ultimately is a price signal of risk, essentially.
So if there's a lower capital risk weighting, you'd imagine the mortgage would be cheaper?
Or else being equal.
Yes?
Yep.
Okay. So then, how much capital is currently being held against mortgages across the banking system? Do you have that number there?
You mean in dollar terms?
Dollar terms, yeah.
I don't think we've got that particular number.
Take it on notice.
We can certainly take that one on notice.
And can you also take it on notice how much capital is being held against first home loan mortgages? Do you have that distinction in your data set?
We don't have it cut in that direction. I suspect we don't have it cut in that way, but I can certainly confirm that.
You don't know how many first home mortgages there are?
We do have data on numbers and volumes. We don't necessarily have the attribution down to the average risk weights associated with them, because to be able to do that, you need to break it down into all those different risk characteristics I mentioned before.
But wouldn't the banks provide that as part of their reporting obligations?
Well, that's something we'll have to confirm. As I say, off the top of my head, I suspect we don't have that attribution on the capital basis as opposed to the dollar flow.
Okay, so when you deploy your macroprudential tools like a serviceability buffer, do you give consideration to first home buyers specifically?
So thank you, Senator. So our macroprudential tool set has a range of factors within it, serviceability buffer being just one. It's important to recognise that actually there are different measures that we're using that work in concert with each other, and the purpose being the overall resilience of the system against shocks in plausible and plausible risk scenarios. It is a broad tool, and it doesn't relate to any one category. And that goes to our other feature of our framework, and which we give explicit guidance around exceptions. So that example of first home buyer, the right type of first home buyer with a profile which would support an exception, that's something that can be explored. But it's not any one category that's carved out. Just as you heard earlier as well around the risk weights, actually, the risk weights around and the risk performance of first home buyers and owner occupiers across the system is very similar, so they would deserve the same amount of resilience, protection.
So are there any buffers in the current risk weighting models, do you think?
Buffers in what sense?
Well, I mean, the banks are holding above and beyond their regulatory capital obligations. Do they have any room there, or are they on exactly where you want them to be?
So look, I think it's fair to say that we think that there's an adequate amount of capital in the system today. There are regulatory minima, and routinely, as in all jurisdictions, banks will maintain a certain degree of buffer to absorb volatility of swings up and down. But overall, we think that the capital in the system, the system's well capitalised, and that's what makes us a strong financial system.
Okay, so the last question I have before I break out the call is just in relation to the point you just made about it being a broad tool. So clearly, because it is a broad tool, it applies to things like fixed rate mortgages, where there is no potential for there to be an increase over the period of time of the loan. So therefore, having a buffer in place makes no sense.
Thank you, Senator. So I think you might be alluding to interest rate piece that is one part of the consideration, and it is certainly not the aim of the tool. The tool is aimed at a much broader sense of unforeseen circumstances across a range of factors on income factors, expense factors. It looks at credit and leverage. It looks at asset prices, lending standards. It has a variety of aspects that we consider when we are setting the serviceability buffer. I think probably a point of note that just for the Australian system, just worthwhile clarifying, that when we talk about any sort of features of fixing, that's actually often quite short. That might be in a 1 to 3 year period, maybe the longest being circa 5 years. So that's actually quite short in terms of...
The average mortgage is only 7 years now, isn't it?
Of the mortgage and the obligations. But just to be clear, that the serviceability buffer is about a much broader set of considerations. And right now, we are seeing things like non-performing loans ticking up. That's at about a 1% level. Now, that's nearly double what it was in 2016. Are we alarmed? No, we are not, because we think it's still manageable. But we're in an environment where employment is still very strong. And so if employment were to change, we do see that would be a different set of outcomes for borrowers. And that's the kind of resilience we are looking at. So it really is about looking at the circumstances in front of us, looking at the data and looking at the uncertainty in the environment, not a prediction tool of any one part or another, but rather how we see the overall settings.
I mean, as you say, it's a broad tool. You don't take into account the particular factors facing first home buyers. It is a broad tool, isn't it?
Yes.
It is a broad tool, and we take into account factors that we see for the whole system. And you talked about their one particular borrower class. We have given banks, and we expect banks to use, where they see it prudent, exceptions for the first home buyers who might warrant a different treatment. I think it's important to note that not all first home buyers are alike. In fact, they have each borrower, and that's what it shows, whether it be owner, occupier, borrower more broadly, or investment borrower, investor borrower. Borrowers have discrete features, and we're talking about here the overall system stability, the provision of credit, which is holding up, and that banks who know the customers best are able to make those judgments. And that flexibility is available and is being used. I think it is important just on that sense of what is the use of exceptions. We have seen the exceptions use rise from around sort of 2% area to nearly 5%.
Okay.
So we can see that banks are taking exceptions, making exceptions, which we expect and support them to do for the right kind of borrower, such that they are in the position to be able to maintain and their obligation.
Well, of course, I expected you to come to this committee and tell us what a great job you're doing, of course, so you haven't disappointed